Everyone, let's get to the video because the VIX was up about 75% yesterday, one day after we posted about that mysterious 50-cent VIX trader, as you can see on the website, where the trader bet $5.1 million to make a potential $300 million if the VIX is over 60 by February. And I'm not going to lie, I might become a spread trader. And make sure you join the Telegram because we were posting over the past couple days about who is this mysterious 50-cent VIX trader, how they bet $5 million to make $300 million, and we were all over these VIX call spreads. That's right, call spreads in the trade, and so far up right around 100% on the trade. So let's get to it. We had a big spike on the VIX, and why I want to continue to trade spreads. Of course, they work out this good. So let's go to the VIX here. It's a volatility index. What it measures is the price of SPX options. Now, you can say, Lance, what about UVXY and VXX and all that jazz? Well, I looked at those options before trading the VIX to possibly do a spread. Well, if you look at the, let's say, January options, they're literally double wide, meaning they're 5 by 10 bucks. You just really can't trade those. You know, if you're doing, let's say, February, again, 7 by 12 bucks or so. If you're doing the weeklies, that's really, well, even they're wide, and VXX is, or UVXY is even worse. So you really can't trade these instruments. They're just illiquid nowadays. Barclays kind of ruined VXX a couple years ago, to be honest, as well. So that's why I like the VIX. They're penny to nickel wide options, and really good for spreads. And obviously, if a trader's doing $5 million, 100,000 contracts in the call spreads, who am I to be smart of them? I'm just going to piggyback on the trade. So let's go here to the VIX. We had the spike, and this is implied volatility. So obviously, if implied volatility goes up with the VIX going up. And we had a big move yesterday, actually the second largest VIX percentage gain that we've seen. So perfect timing, right? Now, what I'm looking for is probably a pullback to the mean, which is about 1775. Today, we're already down about, we got as high as yesterday to, let's just turn on the after hours here so y'all can get a little gauge here of where we traded. We traded up to 28 yesterday. So, of course, you're not going to get the perfect top, the perfect bottom or so, but really we broke out over 20. VIX over 20 is very important. And you can see we're still over 20 this morning, even though we have what we call dead cat bounce, which is expected. You're not just going to have the VIX go up, 70, 50% every day. Remember, markets do not bottom on Friday, so I would expect the VIX to trade sideways, maybe go down to that 1775 and then another leg higher going into the new year. But the reason why a VIX over 20 is great for spreads is the implied volatility in stocks are going to go crazy. What I mean by that is, let's just pull up a gauge here of a lot of the big stocks. So let's look at NVIDIA. You see how implied volatility down below is starting to go higher. Let's use another stock out there, like the SPY. See how implied volatility is going higher, or the QQQ. And we're just looking at blank charts here, nothing fancy. You see how implied volatility is high, right? It hasn't been this high since we started getting into some shaky, big sell-off territory there. So what this means for not only indexes, but individual stocks like, I don't know, GameStop's a great one. That one's been high implied volatility. Or, stocks that normal people like trading, AMD, you can see implied volatility high as well. What this means for you as a trader is that now you can go and trade spreads in these names and actually get good premiums. So before, you were basically collecting pennies on the dollar if you were selling some kind of spread. Now you can get more premium. So you get juicy premiums. To give you an example, let's say I want to do the SPY next week, December 27th, and you got Christmas, so you already have a very light trading volume. If you look at the move that the market makers are implying, that's a $25 move in the S&P, meaning you can sell a, I don't know, let's say a $6 put and do the 579 put. These are going to be a little wide here because it's pre-market, and get about a quarter as long as the S&P doesn't move down $6 over the next really 4 trading days with the holidays. That's pretty amazing out there that you're seeing. So it's good if you're a premium collector or you sell credit spreads, but what it's better, and this is very important right now, is for you traders who like to do, let's say, names like Netflix and the kind of the high expensive stocks out there. And just talking about January, which is front month, which is still pretty risky out there, right? Well, you really can't trade these names right now because look how expensive, like Netflix, a $64 implied move. AMD for January, which is 30 days out, and you have the holidays, so it's kind of a light week too. You know, you're spending $8 for an at-the-money call or put, $5 out there. NVIDIA, one of my favorites that we just had a breakdown on. You know, for January options, $9, $7. Look at the put skew, by the way. The put skew is going to be higher because implied volatility. So when you're trading these names, one thing you can do is do debit spreads. The reason why, expensive options with a VIX over 20, you want to sell premium. If you don't like selling premium because you think the VIX can go higher, like me, where I don't want to do credit spreads, because what if we get a VIX to 60 or 50 even, volatility is going to go up. So selling credit spreads is actually bad. What you want is doing debit spreads, because as volatility goes up, the debit spreads make money as the price of the call spread, let's say you have, will go up in value just from implied volatility, Vega. Or if you're buying a bear put spread, it will go up in value, but also to limit the net cost. For example, let's say I want to buy the QQQ 520, let's say 510 bear put spread for a debit. This is going to cost me about $4 as a debit spread compared to just buying the 520 puts and spending $14.40 out there. So if I want to hedge, let's say my book, I'm going to have to spend $1,440 or $1,440 for one contract to buy some puts. No, that's outrageous. That's insane. But what I can do and get a good potential ROI is do debit spreads. Or let's say I want to go out the money on the SPY, and let's say I have maybe a retirement or a big book of stock holdings out there and I want a cheap hedge. I can do something out there like the 580 puts, which is, you know, $6 out the money, and buy, let's say, the 570 puts, $10 wide. And I can do this for about $250 net debit. So you could still get, for example, this trade would cost me $250 and potentially make $750. So I'm getting great potential ROI, but I don't have to pay an arm and a leg for the price of the option. So VIX over 20, to summarize it, what you want to do is you want to do spreads in your trading. When VIX is sub 20, like we've been seeing VIX 16, 15, you know, what was it, 14 not too long ago even, it's fun to buy outright options because volatility is so cheap. So the price of the options are cheap. But now as we have an elevated VIX, doing debit spreads to limit the net cost of your trades, especially if you have a small account, and still get that potential ROI, it is the prime time to do debit spreads. As y'all know, I'm often a hater of spreads. Why? Because we've had the VIX for, I mean, it seems like forever in the 14, so there's no point. Option prices are cheap, right? You have crazy stocks going up, cheap options. Hey, it's fun, it's champagne, it's roses. Things have changed. Use debit spreads, meaning you're buying a debit spread, whether it be a call spread for upside, a put spread for hedging to the downside. It is now the time you want to do it as the VIX is over 20. If we get back down to a VIX 14, 15, hey, YOLO it up, baby, cheap options. But right now is the time, especially on those, I don't even say expensive stocks, but especially on stocks over $100 or so per share. You're going to spend an arm and a leg trying to buy calls and puts in them. Don't do it, because if we start seeing this VIX going higher and higher, you're going to continue to want to do debit spreads more and more and more to limit your risk in trading, which is very important. Let me know in the video what you think. Hopefully you're in that VIX February 30-60 bull call spread. That's working out fantastically with perfect timing out there. So big congrats there. And let me know what other names you want to look at, and we'll go over some potential call spreads or put spreads in maybe these stocks you're looking at trading. And by the way, that MSTR breakdown, whew, great job avoiding that one. I know a lot of y'all got out of it when I made the last video and probably saved a boatload of money. So great work there.